Welcome back to the Deep Dive. Today we've got a really interesting stack of market research in front of us, all centered on the precious metals sector.
And one metal in particular, right? We're talking about silver.
We are talking about silver.
Okay.
And it's fascinating because, it has this kind of dual identity. It's a precious metal, an asset, but it's also a critical industrial component.
Well, that's the conflict, isn't it? It's one of the most vital industrial inputs on the planet.
Exactly. So when you think of silver, I bet you probably think of these wild, massive price swings, volatility that makes even gold look pretty tame.
That's the common perception, for sure.
Our mission today is to really cut through that perception. We're going to use these sources to separate the myth of silver's instability from the reality of what's driving its price right now.
And the main takeaway from all this research is pretty powerful. It suggests that idea of extreme volatility. It's mostly based on a couple of historical anomalies. If you look at the modern market, silver's price movements today are, well, they're mainly a reflection of real industrial demand and, broader macroeconomic conditions.
That is a huge reframing.
Yeah.
We're basically saying silver isn't defined by speculation anymore. It's defined by its actual utility.
I think that's a perfect way to put it.
So today, we're going to unpack those two big historical events that created the volatility myth. Then we'll get into the industries that are consuming most of the silver today.
And finally, we have to talk about the gold-silver ratio. It's a key valuation metric.
Let's do it. So let's start with busting that myth. Where does this idea that silver is just too volatile really come from?
It really comes down to two extraordinary periods where speculation just completely took over and distorted the price. You have to understand them to, kind of put them aside.
Okay, so the first one is the big one, the one everyone's heard of, the Hunt brothers. We're talking 1979, 1980.
Yes, the Hunt brothers saga.
For anyone who might not know the details, just how big was this? What was the scale of what they were trying to do?
Oh, it was. It was almost biblical in scale. The Hunt brothers, they genuinely believed that paper money was failing and that gold and silver were the only true stores of value.
Okay.
So they decided to try and corner the entire global market for physical silver, not just a few contracts, the whole thing, using massive, massive leverage.
The whole thing. So at their peak, how much did they actually control?
Get this. At their peak, they effectively controlled an estimated 2/3 of the world's privately held physical silver.
2/3. That's almost unbelievable.
It is. And this huge speculative push, it just artificially drove the price from around $10 an ounce to nearly $50 an ounce.
In just a few months.
In just 2 months. And that $50 peak had nothing to do with the real economy. There wasn't a sudden explosion in demand for electronics in 1980.
It was pure speculation.
Purely. And when all that leverage came crashing down on what they call Silver Thursday in March 1980, the price it plummeted. That spike and that crash, it left a permanent scar in the market's memory.
So that's anomaly number one, a completely artificial leveraged event. What about the second one? It happened much more recently.
Right. That takes us to 2010, 2011. And the spike happened during the first big wave of quantitative easing.
QE. The Fed was pumping huge amounts of liquidity into the system after the financial crisis.
Exactly. And silver jumped dramatically again.
So for our audience, why does an action like QE cause so much speculative interest in a metal like silver?
It really comes down to fear. Quantitative easing, this big expansion of the money supply, it brings up the fear of really high inflation, of currency debasement.
People get worried their dollars will be worth less.
Precisely. And when investors get scared about that, they rush into hard assets. They buy gold, they buy silver to protect their wealth. But again, that price jump in 2011 wasn't because factories suddenly needed more silver. It was driven by sentiment.
So if we just, mentally take those two events off the historical chart, the Hunt brothers corner and the QE fear spike, what does silver's price behavior actually look like?
It looks much, much steadier. It's really fascinating. When you remove those anomalies, silver's long-term price action, it actually shows patterns that are pretty consistent with the broader market. It tracks economic cycles.
This is why we have to focus on what's driving it today.
And that means looking at industrial consumption, overwhelmingly.
So let's talk about that utility. What is the actual structural need for silver in the economy right now?
Okay, this is the most important number to remember from this whole deep dive.
Really?
Current analysis shows that industrial demand now accounts for about 60% of all global silver consumption.
60%. That's not a small piece of the pie. That is the pie.
It is the dominant factor. It's not a marginal use case anymore. Compare that to gold, where it's still mostly about jewelry and investment.
So this huge industrial demand, it's because of silver's unique properties, right? Its
Yeah.
conductivity is off the charts.
Unparalleled conductivity, yes. And also its antimicrobial qualities. So what are the big engines consuming all this silver?
Where is it all going?
Well, the list is basically a roadmap for the 21st century economy. The number one driver, and it's growing exponentially, is renewable energy.
You mean solar panels?
Specifically solar panels. Silver powder is absolutely crucial for photovoltaic cells. Without it, they just can't conduct electricity efficiently.
How much silver are we talking about per panel?
It's about 20 grams per panel, which doesn't sound like a lot, but when you multiply that by the sheer global scale of solar installation, it's massive.
So as the world keeps pushing towards net zero goals and this energy transition gets faster, silver demand is basically locked in. It has to grow.
It's structurally locked in. Then you have electric vehicle manufacturing,
Where is it in an EV?
electrical connections, battery management systems, even in the glass for defrosting. You also have 5G infrastructure, which needs higher conductivity. And then you have medical tech, data centers.
So these aren't just, passing trends. These are huge generational shifts in our infrastructure.
Exactly.
But all of this demand runs into a really interesting supply problem, a bottleneck.
That's right. And this is a key point from the World Silver Survey for 2025. It highlighted a major constraint. Silver is mostly mined as a byproduct.
Okay, explain what that means in practical terms. If a huge new solar project needs, 1,000 tons of silver, why can't a mining company just go open a new silver mine?
Because dedicated primary silver mines are actually quite rare, geologically speaking.
Right.
Most silver is extracted alongside other metals like lead, zinc, and copper. It's the secondary thing they pull out of the ground.
So the supply of silver isn't really driven by the demand for silver.
Exactly. The supply is inelastic. If demand for solar panels suddenly doubles, the mining industry can't just decide to produce more silver. They have to wait for the demand and the price for zinc or lead to go up first.
So if the global economy slows down and, say, zinc demand falls, silver production could actually fall with it.
Even if EV and solar manufacturers are screaming for more silver,
Yeah.
yes, it creates this natural supply squeeze whenever tech demand is high.
That dual identity again. An indispensable modern metal whose supply is tied to these older industrial metals.
It's a fascinating dynamic. It really limits how quickly the supply side can respond, which puts natural upward pressure on the price.
So that 60% industrial use provides a strong demand floor. But silver is still a precious asset. What drives the investment side of things?
That brings us right back to the macro picture. The investment appeal is still heavily influenced by, well, economic uncertainty, geopolitical stress, and most importantly, monetary policy.
The Federal Reserve.
Central banks, but especially the Fed.
And when we're talking about the Fed's impact, we really need to talk about real interest rates. Can you just quickly break that down for us?
Sure, it's a simple but crucial concept. The real interest rate is just the nominal interest rate, the one the Fed sets, minus the current rate of inflation.
So it's the real return you get on your cash.
It's the real return. And the key thing is that precious metals like silver and gold are non-yielding assets. They don't pay you interest.
Right, your silver bar doesn't send you a dividend check.
Exactly. So if real interest rates are high, if you can get a great safe return from a treasury bond, then holding a non-yielding asset like silver becomes less attractive. There's an opportunity cost.
Which pushes the price down.
It tends to. But when real interest rates fall or even go negative, that opportunity cost disappears. Suddenly, holding a hard asset that preserves value becomes much more attractive.
And when these macro shifts happen, how does silver typically move compared to gold?
It often shows correlated moves, but they're usually more pronounced, more leveraged.
Why is that?
It's a smaller market, for one, and because of that dual identity we keep coming back to. It's part industrial, part monetary asset. So when gold moves up on falling rates, silver tends to move up further and faster.
And we've definitely seen some of that this year in 2025. The sources point to some pretty big gains.
We have. The rallies in 2025 have pushed prices to levels we haven't seen in over a decade. I think the year-to-date increase was something like 45%.
Wow.
And that momentum is really supported by the data. We're seeing inflation fears recede a bit, and the market is pricing in fewer Fed rate hikes. That's effectively lowering the expectation for real interest rates.
So the macro tailwinds are there, sitting on top of that rock-solid industrial demand floor.
That's the picture.
This all leads us perfectly into a really critical valuation tool that analysts use all the time, the gold-silver ratio. Let's really unpack this.
Absolutely. It's a simple idea, but it's a very profound metric.
So what is it?
It's just a measure of how many ounces of silver it takes to buy one single ounce of gold. It gives you a sense of relative value.
And where is that ratio sitting right now in 2025?
Today it's floating around 80 to 86. So you need about 80 to 86 ounces of silver to buy 1 ounce of gold.
Okay, 80 to 1. Is that high or low? What's the context?
It's very high, historically speaking. The long-term historical average, going back centuries, is much lower, typically somewhere between 50 and 60 to 1.
So why is that historical average so important? Does the ratio always try to get back to that 50 or 60 mark?
It's a powerful tendency. It's a classic case of mean reversion. When the ratio gets stretched really wide, like it is now, it's often a signal that one metal is getting ahead of the other, or one is lagging.
And historically, the relationship between the two just sort of pulls it back toward that average.
It acts like a magnet, yeah.
So an elevated ratio of 80 to 1 suggests that silver is basically undervalued relative to gold.
That is precisely the implication. Historically, when we see the ratio this high, it has often preceded these big catch-up rallies for silver, where it gains ground really fast against gold and the ratio tightens.
But analysts don't just look at this number in a vacuum, right?
Yeah.
How does it connect back to that industrial demand story?
Well, that's what makes it so compelling right now. The fact that the ratio is so high, 80 to 1, in spite of the intense structural and growing industrial demand for silver,
Right.
it just underscores the potential undervaluation. It suggests the market still hasn't fully priced in the reality of these supply constraints and the demand from the green energy and tech transitions. The high ratio basically confirms the fundamental story.
Okay, we have to keep a balanced view here. The fundamental drivers seem really strong, but what are the short-term risks? What could still create instability?
You always have to monitor the external factors. I mean, an unexpected move from the Federal Reserve on rates could still shock the market
Because it would instantly change that real interest rate calculation.
instantly, and currency fluctuations are still key. A much stronger U.S. dollar typically puts pressure on metals prices.
And what about on the industrial side? Are there any risks to that 60% demand figure?
The big one, the one you always have to keep in the back of your mind, is technological substitution.
Someone invent something better?
Right. We have to watch for advancements in material science. If, for example, a cheaper, more abundant material was developed that could replace silver in solar cells with the same efficiency, that would be a game changer.
Is there anything on the horizon?
Right now, no. There's no viable substitute that can match silver's performance, but you can never stop watching innovation.
This has been an incredibly thorough deep dive. So let's bring it all home. What's the main takeaway for someone trying to get a clear picture of this commodity?
I think the main takeaway is this. Silver today is a mature market. Its price is shaped by two very real anchors: fundamental industrial need on one side and a clear macroeconomic policy on the other.
And the old story, the shadow of speculative madness from the Hunt brothers.
It's brief for headlines, but it really doesn't define how silver behaves today.
So understanding that the volatility myth comes from a couple of historical outliers, while 60% of today's demand comes from these essential growing high-tech industries. That's the key.
It forces you to stop thinking of silver as just this old, archaic asset and start seeing it as a critical piece of our future infrastructure.
And that leads us to our final provocative thought for you to think about. If 60% of silver's demand is structurally locked into the global energy transition, we're talking solar, EVs, 5G, what does that ongoing non-negotiable need imply for silver's long-term behavior compared to a purely monetary asset like gold?
Its path forward might have less to do with fear and more to do with fundamental global growth. The utility is the anchor now.
A lot to think about there. We'll see you on the next deep dive.